You open your analytics, and the curve is finally leaning up and to the right. Then the payout lands, lighter than expected. Somewhere between super thanks and RPM, a mystery line took a bite. Before you blame the algorithm, meet the real character in this thriller: withholding. If you're a non-US creator getting paid by YouTube or AdSense, the United States wants a slice of the revenue tied to viewers in the United States. Whether that slice is tiny, hefty, or zero depends on one humble piece of paperwork, 3 letters long, and a treaty map most people never read. The first reveal is simple enough to print on a mug. For creators outside the United States, YouTube treats your earnings like US source income to the extent they come from US viewers, and it withholds US tax on that slice. If you don't submit tax info, Google can withhold up to 24% of your worldwide YouTube earnings. If you do submit the right form, withholding applies only to the US viewership portion, typically at 30% unless a treaty cuts it, sometimes to 5, 10, or even 0. That isn't rumor, it's Google policy in black and white, and they spell out exactly how they apply tax to the US portion once you've sent proper forms. Why 30%? Because under US law, when a payment to a non-US person is classified as US source royalties or other fixed, determinable, annual, or periodical income, FDAP for short, the default withholding is a flat 30% of the gross amount, unless a tax treaty says otherwise. The IRS repeats this again and again. Payers called withholding agents must hold that 30% on US source FDAP paid to foreign persons, and royalties are on the list. If you've ever wondered why the numbers seem so stubborn, it's not a platform quirk, it's the statute. Now to the form with main character energy. W-8BEN if you're an individual. W-8BEN-E if you're a company. This is not a tax return. It's your way of telling Google, I am a resident of this country, I am not a US person, and I want to claim treaty benefits for this type of income. You provide your legal name, your country of tax residence, your foreign tax identification number, and, if you're claiming a treaty rate, the treaty article, the type of income, and the reduced rate. The IRS instructions actually say this out loud. The form is used to claim a reduced rate of withholding under an income tax treaty. Fill it correctly, and the withholding agent can rely on it to stop over-withholding. Fill it wrong or skip it, and you default to the blunt instruments. What exactly is YouTube paying you for? For non-US creators, Google generally treats creator payouts as royalties for tax purposes because it's paying for the right to monetize your copyrighted content. Once you've submitted tax info, Google narrows the US tax to the slice of earnings tied to US viewers across ads, super chat, super stickers, channel memberships, and YouTube Premium. If you never send tax info, Google can backstop the system and withhold up to 24% on total worldwide YouTube earnings. Yes, not just the US slice, because there's no valid form on file. The difference between those two realities can be the difference between New Lens Month and we're eating instant noodles. Let's ground this in a creator's week. You live in Portugal. You're purely outside the United States, and your viewers are 40% US, 30% EU, 30% everywhere else. You submit W-8BEN and claim the US-Portugal Treaty Royalty Article with its reduced rate. If the treaty rate is, say, 10% for royalties, Google withholds 10% only on that 40% US slice. Your EU and everywhere else portions don't get touched by US withholding at all. If your country's treaty offers a 0 rate on royalties, and some do, the withholding on the US slice can drop to 0. If there's no treaty, or you don't claim it, 30% applies to the US slice by default. That is how the lever works. Form plus treaty equals rate. And yes, the treaty map changes. Some treaties get updated, some get suspended, some never existed. The IRS maintains current withholding guidance and even calls out special cases where past treaty relief no longer applies, and the statutory 30% snaps back into place. Translation? Never assume last year's rumor equals this year's rule. Check the current treaty position before you click Submit, especially if your country recently changed its status. The paperwork sequel arrives early the next year in the form of 1042S, the information slip that shows what a U.S. withholding agent paid you that was U.S. source and how much tax they withheld. If you claimed a treaty rate, the form should reflect that. If you didn't file W-8BEN and they withheld at 30% on the U.S. slice, or withheld 24% of everything because you never sent any form, that also shows up here. Keep this slip. It is the bridge between your U.S. withholding story and your home country tax return, where you may claim a foreign tax credit for the U.S. tax, or, in limited cases, file a U.S. non-resident return to request a refund if the wrong amount was withheld. The IRS explains the 1042-S regime plainly. Withholding agents must report U.S. source income of foreign persons and the tax withheld. This is your receipt. Don't lose it. So when should a non-U.S. creator file a U.S. tax return? Not every foreign creator needs to. If the only U.S. tax in your life is final withholding on FDAP, royalties in our context, and the amount withheld matches the correct treaty rate, many creators simply keep the 1042-S and move on. But if you were over-withheld because you didn't have a treaty on file at the time, or the platform applied the wrong rate, or you believe the income was missourced, you can file Form 1040-NR to claim a refund. That's more work than a W-8BEN done right. So the strategy is to get the W-8BEN right the first time. Here's the curveball that catches a lot of channels off guard. The famous 183-day idea you've heard at parties is not the lever here. The treaty clause that uses 183 days is about salaries of employees working in a host country. It does not decide whether a platform should withhold on U.S. source royalties paid to a foreign creator. In the creator world, day counting doesn't set your YouTube rate. The source of the income and your treaty claim do. The U.S. viewer slice is U.S. source for withholding purposes, and that's why the W-8BEN matters more than your airport selfies. The United States publishes these rules across its non-resident withholding pages and publications. It's about source and FDAP classification first, treaty reduction second. Let's talk through the form itself so you know what done right looks like. You log into AdSense, open the tax info section, and pick W-8BEN if you are an individual creator receiving the money personally. If your channel is paid to a company you own, you'll pick W-8BENE instead, which asks more entity questions but aims at the same destination. Certify foreign status and claim a treaty benefit if you have one. You enter your legal name, your country of citizenship or incorporation, your permanent residence address outside the United States, and your foreign TIN. Then you come to the treaty claim. You select your country, tick that you're claiming treaty benefits, choose the income type. This is where royalties typically appears for AdSense and YouTube, and then select the rate your treaty allows for royalties. Some treaties offer different rates for industrial royalties, copyright, or motion picture and TV. The platform's workflow usually steers you to the category it uses for creator payouts, but you still have to read your country's article and match the right percentage. Submit, certify under penalties of perjury, and you're in business. Google's help pages walk through the menu of W-8 forms and when to use each one. So if you're stuck at the fork between individual and business, go slow and follow their matrix. What happens after you hit submit is invisible, but important. The platform stores your W-8 on file and applies the treaty rate you claimed to the U.S. viewership portion of future payouts. If your country's treaty rate is 0, the U.S. slice pays out without U.S. tax withheld. If the rate is 10, the platform withholds 10 on the U.S. slice. If there's no treaty, the platform holds 30 on that slice. If you never send tax info at all, the platform is allowed to withhold up to 24% of your total worldwide earnings from YouTube, because it can't legally assume you're foreign without a form. That is not the platform being mean. That is the platform obeying U.S. backup withholding rules when there's no valid certification. Again, the cheapest tax you will ever pay is the tax you avoid by filing the right form in time. You might be asking, what about shorts bonuses, brand deals, and affiliate links? The answer is that each stream can have its own tax personality. Payments that come through AdSense for YouTube monetization follow YouTube's withholding logic because Google is the withholding agent. A direct brand deal paid by a U.S. company to your foreign company isn't processed by YouTube. That brand becomes the withholding agent and will ask for its own W-8BEN or W-8BENE. If you perform services physically in the United States for that brand, say you film an ad in Los Angeles, different U.S. rules can apply. and part of that payment might be treated as effectively connected income, which means a U.S. return is more likely. This is why creators who travel for shoots or conferences should keep a calendar of where services were performed. For pure platform revenue earned while you're outside the United States, you're usually in the royalty withholding world we've been talking about. Meanwhile, back home, you still need to report your worldwide income in your country of residence and claim a foreign tax credit for any U.S. tax withheld that your country recognizes. The 1042-S is your evidence packet. It shows the U.S. source royalty amount and the tax withheld. Many countries let you credit that tax against your domestic bill, reducing or eliminating double taxation. If your domestic return ends up with a higher tax than the U.S. withholding, you'll pay the difference at home. If your domestic system would have taxed it less, you don't get the U.S. money back from your home country, but you can sometimes get it back from the United States by filing 1040-NR if you qualify. Plan your cash flow, expecting both systems to want their say. There are 3 horror movie mistakes that keep repeating. The first is assuming the 183-day myth can save you from platform withholding. It can't. That rule lives in treaty clauses about employment salaries and has nothing to do with U.S. source royalty withholding on platform payouts. The second is leaving the tax section blank because you aren't in the United States. To the platform, you are a foreign payee until proven otherwise, and without a form they are required to protect themselves with heavy withholding on everything. The third is claiming treaty benefits you don't actually qualify for. Wrong article, wrong rate, wrong country of residence. Withholding agents can rely on a valid form, but if the IRS later challenges your claim and the facts don't support it, you can end up chasing refunds, or worse. The IRS publications on non-resident withholding and FDAP are dry, yes, but the core is simple. Source first, treaty next. Paperwork always. If your head is spinning, come up for air with a clean, creator-friendly workflow. As soon as your channel is monetized, open the payments profile and submit W-8BEN if you're paid personally, or W-8BEN-E if you're paid through a company. Use your true country of tax residence, not a mailbox. Enter your foreign TIN. Many treaty claims require it. Read your country's treaty article on royalties before you pick the rate. When in doubt, a conservative rate avoids ugly letters. Check your next few payouts and compare the U.S. viewership percentage in analytics with the tax actually withheld. They should rhyme if your treaty rate is working. When 1042-S arrives, download it, store it with your invoices, and hand it to your accountant at home, along with your platform CSVs. If you changed countries mid-year, remember that treaties are residence-based. Update your W-8 when you move, because your eligibility and rate can change with your residency. Let's end with 2 quick storylines. One nightmare, one glow-up. In the nightmare, a creator in a treaty country never submits tax info, gets the no info default, and sees up to 24% taken out of total worldwide YouTube earnings. They finally submit a W-8BEN 6 months later, but there's no retroactive magic. The old withholding is stuck unless they file 1040-NR for a refund, which takes time and patience. In the glow-up, another creator in a zero-rate treaty country submits W-8BEN correctly on day 1, selects the royalty article, and watches the U.S. viewership slice payout with 0 U.S. withholding. At home, they still report the income and pay local tax, but there's no double tax sting because there was no U.S. tax to credit. Same platform, same audience split, radically different outcomes, all because of one form in a treaty table. Here's the heartbeat of the whole system in one breath. Platforms withhold because U.S. law tells them to withhold 30% on U.S. source royalties paid to foreign persons, unless a treaty says less. The W-8BEN is how you prove you're foreign and claim less. YouTube narrows the U.S. tax to the U.S. viewer slice once you've filed the form. Skip the form, and they can withhold on everything. Each February or March, the 1042-S appears to summarize what happened. Your home country still taxes you, but the treaty network and foreign tax credit rules are there to stop true double taxation if you keep your paperwork straight. Keep it straight. It's the difference between a channel that scales and a channel that stalls.